Thank you very much, Dr. Ludwig, and welcome everyone to Deutschland Powerthon 2021. Uh, so this is the first climate neutral Microsoft Dynamics community event, and this is the last day, and this is the first session which is in English. All the sessions so far since last 5 days were all in German, mostly in German, I think. I'm happy to present the first session in English today. So here are our sponsors for this Powerthon. Thanks, everyone. Right, so just a brief introduction about me. I'm Satya Kejriwal. I'm finance and operations solution architect, having 15 years of experience. And right now I'm in Sydney since last 4 years, all settled in Sydney. Right, and with me today, I have my co-presenter Anand Singh Verma. Right, so Anand, if you can introduce yourself briefly.
Yeah, hi everyone. I am Anand Singh Verma from India, and I am chartered accountant by profession here in India and doing my practice in the area of taxation and accounting since last 15 years. So luckily I got a chance to be a co-author with the Satya, and we are here to present about the book today. Is it Satya?
Thank you, Anand. So Anand is in India. He who's a co-author with me. So we'll be talking about book as well, but we authored recently. So we will touch upon that about book because some of the topics and most of the topic we are covering from the book. Right, so today's topic will be stick to the basics, D365 finance. So we are not going to talk about big things. We'll not talk about how this ERP works or what are the new features or new things coming in this ERP. Right, so it's a very simple topic, but I would say this is the most important thing as a consultant, what you should know, right? And I ask everyone who are new to the industry to go through these basic concepts, right? So people try to jump to the advanced concepts, try to jump to the system directly and forget the basics. So that's the topic of the day. Right, so I would like to start the session with this excellent quote from Benjamin Franklin. An investment in knowledge pays the best interest. So congratulations to everyone who is watching us live today, or even if you're watching on the YouTube, next 45 minutes, you are investing from your life that will pay the best interest in your life. Right, so that's the investment you're doing for yourself. Right, so this is the agenda of the for next 45 minutes. We will start with the basics of finance, like a finance consultant don't understand finance, right? So this is a very rude statement from me, but that's a fact. So I will cover that, like why I'm saying it. Okay, what's the difference in finance and accounting? Some accounting concepts, something about debit and credit. Again, most of the people are confused about debit and credit. I know this is a very basic thing, what people learn in the school and college, but still, see, not all the consultants come from finance background or accounting background, right? So it's a very important to understand how debit and credit works. And then IFRS and International Accounting Standards. So Anand Singh Verma will share something about IFRS and what the difference in IFRS, IAS, then financial statement, financial risk. So again, I'm not going to talk about D365 or like how technically it works, right? So we will stick to basics. That's the agenda, right? Okay. So let's start with a story. It's not a story, it's just a small example of why I started thinking about this concept, like the basics of accounting, and why I wrote this book, and why like again, writing a book is a big task. It's a very laborious task, but why I thought I should be writing something, right? So it started in 2014. That time I was in Philippines, because I spent 4 years of my life in Philippines. And I was interviewing some people, some finance consultants, right? So some finance consultants come from non-finance background or non-accounting background, so which is fine. But some come from accounting background, right? So I was interviewing one person who was a chartered accountant. I asked very basic questions, which I generally ask in the interview, like when you sell some asset, what is the accounting entry? When you buy something, when you purchase, create a purchase order, create invoice, create like receiving of the inventory, what is the accounting entry? So I saw people are still struggling in those basic accounting entries, even if they are chartered accountants or accounting background. They find it very hard to interpret their accounting knowledge into ERP accounting knowledge, right? So that was beyond my apprehension. Like, why is it happening? Like, people are coming from finance background, why they struggle in this area? So I thought, why not to write some blogs on these topics to educate people, to educate the finance consultant, even non-finance consultants. Um, so I started writing some blogs. In a few days, I thought blogs are kind of very scattered sometimes, because people go to the blogs in a very random way, right? You are doing Google and you stumble upon some blog, right? So you don't really go in a structured manner to read through those blogs. So I thought, why not to compile these blogs and make a book, right? So it took some time, took a few years to like compile this book and to come to the market with the book, right? So I started in 2015 writing blogs, and it went up and down, and only recently, in last 2 months, 2 months back, we released this book, and Anand really helped me a lot to talk about IFRS and some advanced concepts of accounting. Right, so that was the small story behind about this book. So now we'll be talking about few things um, which I have given in the book, which we have written in the book. Right. So accounting to finance, right? So accounting and finance, what is the difference? Most of the people don't understand what's the accounting, what's the finance, and people take it as a kind of synonym, like there's no difference. And actually, there is a difference, but there is a very thin line of difference in accounting and finance. So I would say where the accounting ends, finance starts. Right. So accounting is all about recording all the transactions and what happened in the past, right? You go to the go out and travel and submit your bills. All those transactions are entered in the system, recorded in the system. That's part of the accounting. But what happens after that? Like, you do all the analysis, right? And you do some budgeting based on that. You do some forecasting based on that. That's part of finance, right? So for let's say in D365, we a lot of accounting. Definitely, there is accounting everywhere. But let's say the budgeting is part of finance. Forecasting is part of finance. Some analysis, some reporting, those are part of finance. But again, we don't need to go into the core difference of these. Let's take it as one concept. But if you're a finance consultant, you should understand the nitty-gritty of these both concepts, because when you go out in the market to the client, you will see finance is one department, accounting sits into that department, right? As one of the group of people, they are from accounting. Okay, moving on. Accounting principles, again, there are more than 10, 15 principles in accounting, right? But what are my top 5? I don't want to bog you down with a lot of concept, lot of theories about accounting. Top 5 concepts which everyone should understand, right? Who wants to understand accounting? These are top 5 from me, right? So first is dual aspect concept, right? So dual aspect concept means if there's a debit, there'll be credit, right? And debit credit should be balanced, right? As you can see on the picture, Thanos says, as all things should be, debit and credit should be perfectly balanced. We'll talk about this concept in the next slide. Accrual concept. Accrual concept is again one accounting concept which is common now. There used to be a time when there was cash accounting, like whenever cash goes out, only that time you record your transactions. Now you need to accrue. You need to accrue even if the cash is not going out now. You need to accrue. You need to book those expenses, right? So that's like in summary, that's the accrual concept. Like accrual is different from cash accounting. Yeah, sorry. Next is the going concern concept. Sorry, I don't have the image for that. Going concern concept is, sorry, excuse me for the wrong spelling here. This is a going concern concept. It means all the concerns, all the organizations run based on the assumption that they will run for forever, for a long time. They don't work on the basis like we will be closed tomorrow or we'll be closed in a year. Like there are exceptions to that rule. Some organizations are formed for a specific project. Let's say I'm building a metro train that will go for 2 years, 3 years. So that's a joint venture, or the special purpose vehicle that's built for 2, 3 years. That's a different thing. But generally, the organizations are based on the assumption that it will go on forever. That's why we have the concepts of fixed assets and depreciation, right? If we assume we will be gone tomorrow, there will be no depreciation. We will just write off everything today, right? And that's why we categorize long-term asset, short-term asset. So that's again a basic assumption of accounting. Consistency concept. Consistency means we should be consistent in all the accounting treatments, right? Definitely there are exceptions to it, but normally what auditor will also ask you to be consistent. So you are following one accounting principle today. Let's say you are valuing your inventory based on weighted average, right? So you can't change it. You can't change it every year. You can definitely change it, but you need to declare it that I'm changing this accounting principle for this reason, right? Maybe you are like incorporating one new, like merging new entity in your business. That's why you need to change the accounting, or maybe you are foraying into some new market, and that's a requirement of that new market, right? But we generally can't keep on changing it, right? So you should be consistent in your accounting treatment. Last one is conservation concept, which is basically based on like this is a playing safe concept. Means we will always assume that in future we might have loss, right? So let's say in the banking industry, when we give the loan to people, we always keep a provision of bad debts, that some people will default in the loan. That's why we create provisions, but we never assume there'll be future like windfall profit in the future. So we don't create provision for profit, but we create provision for losses or the expenses, right? So that's why it's called playing safe. So we don't overestimate the profits. Right, so these are top 5 accounting principles from me, but definitely you should go through other concepts, which are again the foundation or the building blocks of accounting. Now, yeah, so we talk about debit and credit in the previous slide, dual entry concept. So debit and credit, again, it's a basic thing, but still most of the people are confused. I saw even the accountants sometimes are confused in debit and credit. And this is the first thing. If you are listening me today on YouTube or wherever, and I might interview in future. So just make a note that I generally ask accounting entries in the interview, right? Very basic accounting entries. So be ready for that. So why people are confused and what are the confusion? It's a like no common confusion is why debit is right side or why credit is left side, or sometimes say people write it other way. Why banks are saying we are giving credit to you, and sometimes they like debit to you. Why their credit is my debit, right? So those kind of confusions are very common. So I'll not talk about this in detail. This is not a topic that can be understood in half an hour, but we'll try. Okay, so what you need to do to understand debit and credit is, first of all, is the types of account. What are different types of accounts generally you create in your chart of accounts or subledger, right? So ledger and subledger is another concept when you design a chart of account. So in types of account, first is the personal account. So what is personal account? All your debtors, creditors, those are called personal accounts. So personal account means any company, any person which you're like selling to or you're buying from, right? So those are called personal accounts. Real accounts, all assets, all liabilities are real accounts. So personal and real together, both of them make your balance sheets. So all the balance sheet items fall under personal and real accounts. Third one is nominal accounts. All profit and loss items, expense, revenue, income, loss, all fall under nominal accounts. Now, why this is important? Because based on this categorization, we have our next slide, which is the golden rules of accounting, right? So let's see. So just remember that personal, real are make the balance sheet, and nominal make your profit and loss. Okay, so here comes the golden rules. Again, if you're new to accounting, just take a snapshot of this. You need to remember this. You need to like refer to this slide whenever you like someone asks you accounting. Okay, tell me what is the accounting when you sell it asset. Right. So let's go through this. There are two rules in accounting. One is debit, the increase in the asset; credit, the decrease in the asset. So and the and other way as well, right? Credit the increase in the liability and debit the decrease in the liability. So this rule is applicable to personal and real accounts. If you go back to previous slide, so these two types of accounts follow first rule, right? So if your asset is increasing, you will debit that account, right? I'll give you example in the next slide, don't worry. And similarly, if your liability is increasing, you will credit that account, right? And ultimately, whatever transactions you do, your debit should be equal to your credit. Second rule is debit all the expenses and losses, credit all the income and profit, right? This is applicable to all nominal account, which is all your profit and loss account. And you can also understand it by this picture. When we talk about assets or expenses, this is debited when these are increased. When these go up, you debit this account, right? And liability and income follow the same rule, and equity as well. When these are increased, it is decreased, then it is debited, right? So let's take one example now. This is the example. Now I'll be talking about a little bit of D365, which I said we will not talk, but I'm just giving a reference of D365. And actually, this is applicable to any ERP, right? Wherever you go, SAP, Oracle, any ERP, you will follow these kind of, you will see this kind of accounting. So when you sell any inventory to a customer, there are two parts to that transaction. First is the AR side, like you sell to something to customer, so you debit the customer account, right? Why? Because customer is a personal account, and customer is increasing because my customer balance will be increasing now. So my first rule will be applicable here: debit the increase in the assets, right? And here my sale is increasing. Sale is my revenue account. So now rule number 2, second golden rule will be applicable. When revenue increase, you will credit all the income and profit, right? That's how you can apply these golden rules to your transactions, right? So second part of this transaction is, which we will try to link to one IFRS as well when we go and talk about the IFRS. Second part is the expense booking. So this is the asset booking. You are selling something, so you are increasing your customer. This is the asset side. This is the expense side. So I need to book my cost of goods sold, right? So inventory goes out. So anything I sell, there is some expense behind that because I bought that inventory sometime in the back that was sitting in my warehouse. I am consuming that inventory, or I'm using that inventory to sell, right? So that will be counted as expense. So that expense increase now. So that will be cost of goods sold because this is a nominal account. And second golden rule will be applicable here. So I need to debit all the expenses. So that's why it's debited. And then asset is credited because asset is a real account, right? With balance sheet account, it is decreasing because now my inventory in the godown will be reduced. So I need to credit that account because my asset is decreasing. Again, it will take time. You won't understand this in 5 minutes, but keep on following this rule, keep on applying these two golden rules to any transactions, you'll never fail. Right? So everything is covered in these two golden rules. Okay, I'll go back briefly just to recap, because again, this is the basic, or this is the like first step you take in the accounting. Like what are types of accounts, what is debit, what is credit. Only then you take the next step, right? So you can never skip this. But 3 types of accounts, 2 golden rules, right? And there is some examples. So if you have read my book, you will see a lot of examples about debit and credit, and you will see the real life example from D365 also. So we try to link all the transitions of D365 with these golden rules. Okay, now it's a little bit advanced concept if you are new to the accounting. But again, when you go out talking to the clients or talking to CFOs, they will ask you, okay, is your ERP compliant to IFRS, right? Many consultants never heard about IFRS. They get like, I'm not sure, or I need to check, right? So IFRS is not a big thing, right? But again, not all the ERPs are compliant to IFRS also. Now everybody's trying to catch up because IFRS is always evolving, right? So let's hear from Anand Singh Verma now. He'll talk about some background of IFRS, what the difference in IS and IFRS, why was it introduced, and how many countries have adopted IFRS. If you learn about IFRS now, will it be applicable to like wherever you go? Like I'm in Australia, so is it applicable here? I learned if I do a German project with Dr. Ludwig, maybe Will it be applicable same IFRS, or I need to learn new types of accounting rules there? Right. So Anand, if you can take over from here for next 3-4 slides on IFRS.
Yeah. Let me first take you through the why IFRS were introduced. Way back in year 1973, professional accounting bodies from most of the developed countries like Australia, Canada, France, Germany, Japan, Mexico, US, UK, they decided that there should be standardization in accounting standard, because every professional accounting bodies, they have their certain set of guidelines to prepare their financial statements. But as we know that now world is a global village, we can see there are lots of MNCs who are working in many countries. They are preparing their financials as per the investors' need from many countries. So to make the accounting and financials globally readable and understandable, they decided to form a committee called the International Accounting Standard Committee. And this committee releases certain accounting standards, obviously using the Golding accounting principles you just mentioned, Satya. So based on those standards, they release certain accounting standards to recognize certain things like revenue. If there is a revenue, how it should be recognized in the financials, and if there are certain expenditures, there are capital assets or there are capital expenditure, how it should be recognized in the books of accounts. So in India, suppose there is one company which is following cash basis of accounting, and in Australia they are following the accrual basis of accounting. So those two financial statements were not comparable. We cannot rely whether the information which the investor, if you see from the investor's point of view, whether those provides the real and true picture or not, and whether whatever information I need to know, whether those information are there captured in the financials or not. So this IASC was the first body, first body we can say it was a group of financial professional accounting bodies which were formed in 1973, and later on with the change requirement in 2001, the name of IASC changed to IASB, which is International Accounting Standard Board. And nowadays IASC is the governing body to issue the accounting standards. The earlier name, when IASC used to issue the accounting standard, they used to give it a name as IAS, which is International Accounting Standards. And now it is because this is not accounting standards, it includes many reporting requirements as well. So they have named the IAS, the new the set of accounting standard, they named it as IFRS, International Financial Reporting Standard. So it tells about how to recognize, how to measure the accounting, and what are the reporting requirement, what should be there in the financial statement. It gives us the what constitute a financial statement, what should be the minimum reporting there in the financial statement. Say in a financial statement, there are let me
Almost 10 of the IFRS like talks about
these 10 of the IFRS,
right?
they talks about the reporting requirement. Then the main IAS one, which tells about the preparation of the financial statement and what constitutes a financial statement. It will say normally in one country there may be one structure of preparing the financial statement. In another country there was some another. But now they have standardized it. If one follows the international accounting standard, then to constitute a financial statement, it should consist at least the financial position, financial performance, and the cash flow statement. When we say the financial statement, it should it should contain statement of financial position, which is called balance sheet in a layman language, statement of profit and loss, which is a profit and loss statement, statement of change in equity. The statement of change in equity shows the change in shareholders' worth. It shows what is the change in the net worth of the shareholder of the company. And then cash flow statements. Again, cash flow statement is based on the actual cash flows. If we exclude the accrual things from the books, then we can get the actual cash inflows and outflows. And the cash flow statement shows the what is the cash inflows and outflows in the company during one particular period given in the financial statement. And apart from all these statements, we should give notes on all these things, the notes to the financial statements. So whenever an investor see the financial statement from one country and compare it to another company, now these are comparable. They can see, they can compare, that there is apple to apple comparison if both the financial statements are prepared on the basis of IFRS. So the question is, how many countries have adopted the IFRS? Approximately, I believe 120 countries have given their consent to adoption of the IFRS, and most of the countries have adopted IFRS as it is, as issued by the International Accounting Standard Board. But in many countries like India and Australia, there were many such restrictions because of their local laws and other requirement. Instead of adopting the IFRS issued by the IASB, they converged their own accounting standard, which is at par with IFRS. So, although those countries are following IFRS but not adopting IFRS as it, they have converged their accounting standard, which is at par with IFRS.
Yeah. So they are still corporate compliant, right? And if you are
they are still, yes, they are still compliant, but there is one major requirement if to demonstrate that we are IFRS compliant, there should be 100% IFRS compliant. If even there is one IFRS which I am not following, I cannot write that my financial statements are IFRS compliant. So this was the reason, instead of adopting IFRS, we converged. So most of the countries converged their accounting standard, which is in line with IFRS with certain carve-outs, which is not minor. So when we compare the two set of accounting standards, what we can do, by eliminating those few carve-out, we can make those financial statements as good as, or at least 100% at par with the IFRS.
Compliant. Okay.
So what is the next slide, please?
Yeah. Thanks, Anand. I can cover from here because we talk about some D365 ERP as well. So we'll talk about one of the IFRS, which is IAS2. Again, I'm using IAS and IFRS as a synonym, as Anand said. IAS was a kind of previous name. Whatever changes now happening in IAS, the body is now started calling them IFRS, right? So I'm taking one example from again from the book. In the book we have like detailed many of the IFRS, but here is one example. So IS2 talks about the inventory, right? So how to measure the inventory value, how to what are the valuation method you can follow, and how to recognize the expense, right? So IS2 requires cost should include cost of purchase, right? So you buy something, so that's your purchase cost, cost of conversion, anything that is to convert that item into the full-fledged item or the final state, and any cost to incur to bring it to the warehouse and bring it to the state where it can be sold, right? So it's a sellable item. So that's all the costs should be added to the item cost, right? So in D365 ERP, we have few things like landed cost module, which is again very new baby in the bucket of the modules. launched recently. Before that, we used to use auto charges, right? Automatic charges was like commonly used. Now there are, if you're in manufacturing organization, you are using the bill of material that can load all the cost of the component cost to the product, or the cost sheet, right? So how D365 handles it, like using all these components. There are a few more. I'm not listed everything here. Valuation method wise, IS2 um, gives flexibility to adopt any of these accounting valuation methods. Definitely one method, which is LIFO, is not allowed specifically in this accounting standard. So most of the ERPs, including D365 supports all of these methods. So we are good even there. Expense recognition, when inventories are sold and revenue is recognized in P&L. So we already talked about this when I was talking about the accounting for the sale entry. Um, so again, this is an automatic transaction in the ERPs, right? When you get a sale transaction, when you post a sales order, your COGS or cost of goods sold accounting is automatic, right? Okay, so that's the requirement of IFRS. Like so far, we didn't know this IS2 requires you to do that, right? So when I started my career, it was happening, and it was kind of like a pleasant surprise for me. Like system is doing it automatically, right? People don't have to manually calculate end of the month and do the COGS calculation, right? So system is doing it for you. Other than this COGS calculation, there might be some a write down of inventory because of the market value is reduced. As I said earlier in the accounting concept, if you should always provision for your losses. So now market value is going down. So there is one rule that cost or market value of the cost, whichever is low, you should be booking your inventory at that value. Right, so cost or net realizable value, NRV, right, whichever is lower. So if the NRV is lower than your cost, you should be writing down your cost and create the expense entry in your system, right? So that's the kind of journal entry. You don't really like system can't help much because this is a kind of manual calculation outside of system. So again, this is one of the example how ERP supports IFRS requirements. What are the other IFRS, which are like popular IFRS, which every company needs to follow? Like again, these are my top 5 or top 6 IFRS, right? So which you should always be looking at. You should all like converse yourself with these IFRS specifically if you don't want to go in detail of everything. Right, so one is inventory, which we just talked about in previous slide. IS 21 about foreign exchange. So in D365, general ledger and forex revaluation, all those. I think this is a very strong module that supports almost 100% of the requirements of this IAS. Fixed asset module complies with property, plant, and equipment IS 16. Government grant related requirements in IS 22 are met with project module. Revenue from contract with customer, that's IFRS 15 and IFRS 16. Those are like two more IFRS where Microsoft has recently invested a lot, right? So they are building this lease accounting module and also revenue recognition. They have done a good job, right? So these are my top 5 or top 6 IFRS everybody should be conversed with. So we are running out of time. Now we have 5 minutes short. So Dr. Ludwig, are we okay to spend 10 more minutes? I have a few more slides.
We can continue. Our next speaker
I know, yeah.
Would not make it, so just continue, please.
Yeah, thank you. So few slides we'll be talking about now is on financial statement. So we talked about the basic accounting, debit and credit, IFRS, and now again this is also basic financial statement and financial ratios. But again, when you go out to the client first time, you should be knowing this. You should be talking this language, right? You can't go and start talking like chart of account, journal, configuration, parameter, all these. Like those are kind of German to my Australian client, right? First, you should talk the language of the client, and the client is most of the time is CFO, right? They are the main stakeholders in ERP projects. So you should know what language they speak. So again, whatever we had talked so far, that's the language accountants speak. IFRS, debit, credit, financial statement, cash flow, right? Auditing, taxation, all these things. So as Anand has covered already in one of the slide about IFRS, financial statement, there are around 10 IFRS or 10 IAS, which only talks about disclosure presentation of the financials, right? So you can understand now how important is this financial statement is, because as Anand said, every company or every country is trying to align the financials of their financials with the other countries so that you can compare apple to apple, right? Now, first thing we should be I'll be talking about now is income statement in the financial statements. Again, I'll not talk about everything. I'll take you through top 3 concepts. Again, these are my own top 3 concepts, my favorite. Again, this screen is taken from the book, our book, Financial Statement with Microsoft Dynamics 365, where we explain all these sections of income statement point by point, right? So what is the meaning of total net revenue, how gross profit, how much gross profit is the ideal gross profit, how much is the ideal net profit percentage. Okay, so from income statement, my top 3 are top line. You must have heard a lot about from many professionals. What is my top line? What is my bottom line? Right? What is my EBITDA? Right? So again, if you're new, you will be definitely confused. These are not very commonly used in like day-to-day language. So top line is the total sales of the company, and bottom line is the net profit of the company. Again, you can see this is very clear. This is the top line. This is the bottom line, right? And the EBITDA comes somewhere in the middle, which is the earning before income tax, depreciation, and amortization, right? So many of the analysts compare EBITDA of use EBITDA to compare the financials of two companies, right? Instead of using the net profit, right? But again, people have different arguments about using the EBITDA or net profit. Okay, but I've seen stock market works based on the EBITDA, but definitely the profit what you declare in the market, that's the net profit. Okay, next is balance sheet. Balance sheet, we again will not go into each section. Few key concepts, short term and long term, right? So I'm calling it out again. We covered it initially. Going concern concept of an organization means this organization will go for long. That's why we have a concept of short term asset, long term asset, right? That's why we have a concept of depreciation. So in the IFRS, there is a requirement to categorize every asset into short term, long term, right? So people should like investors or shareholders should know how much money is locked into long-term assets, like that will not be realized very soon. Right? Shareholder equity is the second key concept we should understand is this, which is a kind of difference in your total assets and total liabilities. Right? So your total assets are your asset minus what you need to pay to your banks, your other creditors. So difference of that becomes your equity, shareholders' equity. Right, so that will include your equity capital plus any retained earnings. So let's say your business is going on since last 10 years. So whatever you earned so far and you haven't distributed as a dividend, that becomes your retained earning. So that's all your like shareholders equity. Okay, a few ratios we should be talking about here. I'll not go in detail here. Current ratio is your ratio of current assets to current liability, and debt to equity is total debt to total equity. Again, these are very important when you go and analyze a financials of a company, right? How much is the leverage of a company? How much this company is based on or relying on the debt, the bank's debt, or the any other debt from other creditors. Moving on. These two concepts, EPS and PE ratio, again, this is summary of your previous two slides. What share market look at? Earning per share, right? Every company has the earning per share. It's not your dividend, it is the earning. So your net profit after tax, that's the bottom line, divided by number of equity shares. That's is your EPS. How much is your earning? Even if you're not getting it through dividend, that's your earning as a shareholder. P ratio is share price. What is the market price now divided by EPS? That's your PE ratio. Again, this is the most important concept when you are comparing. This is the single ratio, I would say, like that gives a lot of information. So how to interpret this P ratio is stock with low PE are considered value stock. Value stock means where you can invest easily. Definitely there are a lot of things to look at, but that's the starting point. Filter all the stocks which are where PE is less than 15, right? So that's the starting point. High PE means the stock is overvalued. It's very high in the market, price is very high, right? So stay away from there, those stocks. But definitely some Tesla-like shares where PE is much higher than like 15, still like it's going up. So there are exceptions to all the rules. So last slide here in my presentation is cash flow. Cash flow is the third pillar from the financial statement. Last one is the notes to the accounts. So notes to account are just the disclosure statements. But these three, balance sheet and P&L and cash flow, are something where system can help to generate these statements, right? So, you know, if you're D365 consultant, you know, in financial reporters or the Power BI, you can generate these statements easily, right? So cash flow, again, cash flow is about cash flow. How much is the cash flow, positive or negative, from your operations for the whole year, right? So it's different from profit because cash is king, you know that, right? If you are a very strong balance sheet, but you don't have cash, it means there is something wrong. So cash flow is very important to analyze how much is the cash flow you are generating from your business every year. Right, so guys, thank you very much. That was my presentation on stick to the basics, D365 finance. If you have any question, that's the right time. You can ask me now, or if you want to drop an email to me on my website, you can drop an email, or wherever, like, or LinkedIn.
Yeah. So thanks a lot, Satya.